there's a story I want to share with you about why it's even more important to save this versus pay your debt early. You see, while I'm paying my debt early, I don't have control over that money. I'm giving the bank, the lender, an extra 50 or 100 or $200 extra a month, but I can't get that back. The bank gets to keep it. And what really helped me understand this was a story from a friend of mine back in 1990. So we're rolling this back, okay? Good 30 years. Back in 1990, her and her husband bought a home. And at that stage of the game, interest rates were a lot higher than they are today. About 10%, I think, was their first mortgage. At least I think that's what she told me. The interest rates of the 1980s, super high, very high. This was to try to curb the inflation that started in the 1970s. If you haven't yet, watch our video on inflation. I'll put the link to that in the doobly-doo because it's really important to take some of these things in historical context. 2% mortgages probably will never come around again, not in our lifetime. So hang on to it. Anyway, back to my friend and her 10% mortgage. Her and her husband decided that they would pay extra on the mortgage each and every month to get that paid off early. And they did, never missing a mortgage payment, paying in extra whenever they could. 50, 100, 200, sometimes even $300 or $500. Now, over the course of the 90s, interest rates started to come down. One of their last mortgages was at about the 7% range. So even when you look at what you might consider high interest rate mortgages today, historically, it's pretty normal. Definitely normal. Okay. But I understand how you want to get the lowest interest rate possible. Makes good sense. And so, yes, as their interest rates went down, they would refinance. And many times they'd also take out a little bit extra to maybe do a home repair, etc. So the debt never really shrank that much. Everybody with me. Now, along comes 2007, and my friend gets a divorce. She makes more money than her soon-to-be ex-husband, and she decides to buy him out of the house. Now, you might not have lived through it, or maybe you did, but the 2008 financial crisis was all about mortgages and housing prices, right? Now, this woman was savvy. She knew that the value of her home was elevated due to all of this, but she was still willing to buy her ex-husband out. More so for the stability for the kids. She didn't want to have to move the kids, and she was willing to pay for it. So she bought him out of the home. At that time, it was appraised for $450,000. She ended up giving him his share of the equity, which was about $125,000. And now she has a mortgage at $300,000. And everything's chugging along fine because she makes some pretty good money and she keeps on with the trend. She's going to make every payment and she's paying extra. She feels like she's getting somewhere. And then comes the crash. Now, the value of that home where it was set at about 450,000 dropped in about half, which effectively meant her ex-husband got his equity and she just lost hers. Everybody with me? But she figures that's okay. She's got the money to pay for it. Her kids are safe. Everybody's okay. I'm sorry, I'm going to get a little teary-eyed on this because it's an emotional thing. You see, this is the thing. Our emotions are wrapped into our finances too. The reason she did this was to try to keep her kids in their home. So I want you to hear the rest of this story. It's 2008. She lost her equity. Boom, gone. But she still got a good job and she's still making good money. And in fact, her income keeps going up. She is okay, and so are her kids. But then she loses her job. This happens at about 2010, and it takes her a while to find a new one. I can't remember what she told me. It was like 8 months, a year. And the new job wasn't anywhere near what she was making before. This was all because of the recession that followed. Now, she went to the bank and she asked the bank for something called a modification. Back in those days, there were laws in place, and there still kind of are, that if you suffer a financial hardship, the bank will reevaluate your loan. Well, she was having a financial hardship. And I want you to remember that it is now 2010. She has been paying on this mortgage for 20 years now, always paying and paying extra. She has been a good banking customer, and she feels like the bank will probably treat her well. Well, she gets her modification. You want to know what it was? They dropped the interest rate 1/4%. Now, if she could have qualified for a brand new mortgage, interest rates were now 2% lower than what she had. But the bank only gave her 1/4%. And you know what else the bank did? They took her 30-year term and made it 40 years. This means she'll pay more interest over the entire term. This dropped her payment. I can't remember all the numbers, but by about a 25% amount. This to a woman who now has an income that's 40% less than what she had before. Yeah, that's what she got for paying extra to the bank. She tried for 2 other modifications. Each subsequent one was worse than the first. She tried to do something called a short sale. I'm not sure if you're familiar with this, but this means that you try to sell your home short of the debt that's owed. The bank has to agree to this because of financial hardship. Well, that $300,000 mortgage that she had, she couldn't even sell it for $180,000 in 2012. A house that was valued at $450,000. She also tried to do something called a deed in lieu. Under a deed in lieu, the owner signs over the deed to the lender in lieu of debt forgiveness. Now, many times under a deed in lieu, because foreclosure, by the way, is expensive to the lender will offer the homeowner some lump sum to give them an incentive to do the deed in lieu. It's essentially the money that they would have spent under the foreclosure. So this lovely single mom was hoping that she might qualify for at least that. No, she didn't get a lump sum. The bank asked her to sign over the deed and pay an additional $17,000 to have the benefit of leaving her home. Not kidding you. This is all very true. So when I say don't pay off your debt early, this includes your car, your mortgage, anything. Put it in a savings account instead. When we have money saved, just like it shows in this column to the right, we have power, we have control, we have options. When we pay money to a lender, extra money, they have the power, they have the control. When that lovely single mom turned to me And she said, Renee, I regret every dollar I paid extra on that mortgage. If my kids and I had kept that, we'd have something today. Instead, she lost that home to foreclosure. And sometimes when I share this story in my classes, some people will say, well, didn't the dad help? What do you think? And I absolutely love it when it's a man who asks me that, because I have to believe he is a man of integrity, but not all men are. Well, thank you for staying toward the end. It was worth it, wasn't it? Honestly, that's what changed my mind about all of this. And I think it's the reason why it's so important to save first. It's the best way to get fearless with your finances. Do me a favor, subscribe so that you get more videos just like this. Like this video and please comment. If you've got any questions or other things that you'd like me to talk about, I would love to create videos that are important to your adventure in finances. In the meantime, be fearless and have fun.